January 12th, 2026, 10:00 a.m. Eastern Time. The screen flashes a number that shouldn't exist. Silver, $85.61 per ounce. Not 84, not 83, $85 and climbing. For 45 years, since January 1980, silver traders have stared at one psychological barrier. The Hunt Brothers peak, $49.45, the level that marked the most spectacular manipulation attempt in commodity history. The price that regulators, exchanges, and the entire financial establishment spent decades making sure would never be touched again. Today, that barrier didn't just break, it shattered. And what's happening right now isn't manipulation. It's not a corner. It's not three billionaire brothers from Texas playing games with borrowed money. This is something the system was never designed to handle. This is structural demand meeting structural shortage. This is solar panels, electric vehicles, and data centers consuming a metal that cannot be printed, cannot be synthesized, and cannot be replaced. This is the moment when 70% industrial demand collides with 30 years of supply deficits. And the explosion is only beginning. In the next 20 minutes, I'm going to show you exactly what happened in the last 72 hours, how we went from $80 on Friday to $85 this morning. I'm going to break down why the 1980 comparison is completely wrong. The Hunt brothers were fighting the system. Today, the system itself is breaking. I'm going to show you the three forces converging right now. China's export restrictions that just went live January 1st. The Federal Reserve is rate cut expectations for 2026. And the industrial consumption that is devouring 680 million ounces annually, while mines produce barely 800 million. And I'm going to walk through what happens next. Because $85 isn't the top, it's the breakout. It's the moment when decades of suppression, manipulation, and price control finally lose their grip. And when that grip releases, the snapback is violent. This isn't speculation, this is math. And the math says we're watching a repricing event that happens once in a generation. Let me show you exactly how we got here, and why $100 per ounce isn't a fantasy. It's a timeline. The Hunt brothers' story is financial legend. January 1980. Nelson Bunker Hunt and William Herbert Hunt, sons of Texas oil billionaire H.L. Hunt, accumulated roughly 200 million ounces of silver. They bought physical metal. They bought futures contracts. They took delivery instead of settling in cash. At the peak, they controlled approximately 1/3 of the world's deliverable supply. The price exploded, $6 per ounce in 1979, $30 in January 1980, $49.45 on January 18th, 1980. Then the system struck back. January 7th, 1980. The COMEX Exchange introduced Silver Rule 7, new position limits, liquidation-only orders, no new buying on margin. The Hunts were cut off mid-squeeze. By March 27th, 1980, Silver Thursday, the price had collapsed to $10.80, a 50% crash in a single day. The Hunt brothers lost over $1 billion. They were sued, convicted of market manipulation, and banned from commodity trading for life. For 45 years, that peak of $49.45 stood as a warning. Don't corner silver. Don't fight the system. The system always wins. Except today, the system didn't win. Today, silver closed above $85, and nobody cornered anything. Let me show you why this time is completely different. The Hunt brothers were three individuals. Today, the buyers are nations, industries, and technologies. The Hunt brothers used leverage and borrowed money. Today, the demand is cash-backed, structural, and inelastic. The Hunt brothers fought the regulators. Today, the regulators are irrelevant because the demand isn't speculative. It's existential. In 1980, silver's primary use was photography, jewelry, and silverware. Discretionary demand, substitutable. In 2026, silver's primary use is solar panels, electric vehicles, and electronics. Non-discretionary demand, irreplaceable. The Hunt brothers were trying to create scarcity artificially. In 2026, the scarcity is real. The global silver market has been in deficit for 5 consecutive years. Demand exceeds mine supply by 149 million ounces in 2025 alone. Over those 5 years, the cumulative deficit exceeds 600 million ounces. That's 18,000 tons of silver that was consumed but never replaced. You cannot substitute silver in photovoltaic cells. Its electrical conductivity and reflectivity are unmatched. You cannot substitute it in electric vehicle sensors and power electronics. The performance loss is unacceptable. You cannot substitute it in high-frequency electronics and semiconductors. There is no material on Earth that performs like silver at the same cost and scale. This is why comparing 2026 to 1980 is a category error. In 1980, regulators could stop the Hunt brothers by changing margin rules. In 2026, regulators cannot stop China from building 500 gigawatts of solar capacity. They cannot stop the global automotive industry from shifting to electric vehicles. They cannot stop the build-out of AI data centers that require silver-intensive power infrastructure. The demand is baked into government policy, industrial strategy, and technological transition. It is not speculative, it is structural. And structural demand cannot be regulated away. Now let me show you what happened in the last 72 hours. Because the move from 80 to 85 didn't happen slowly, it happened explosively. Friday, January 9th, 2026, silver closed at $78.74. The market was digesting a week of volatility, some profit taking, some rebalancing, normal. Then, over the weekend, three catalysts converged. First, China's export restrictions. On January the 1st, 2026, China implemented new export controls on refined silver. Only large state-approved companies with annual production capacity exceeding 80 tons can export silver, and they need special government licenses. China controls 60 to 70% of the world's refined silver supply. Even a partial restriction creates instant global shortage. This isn't new. China used the same playbook with rare earth elements, export quotas, licensing requirements, strategic hoarding. The result? Prices spiked, importers panicked, supply chains broke, and China secured domestic industrial advantage while controlling global pricing power. Second, Federal Reserve positioning. Markets are pricing in multiple rate cuts for 2026. The December jobs report showed weak payroll growth, unemployment steady at 4.4%. The Fed is widely expected to hold rates at the January meeting, but by mid-2026, cuts are coming. CME FedWatch shows 87% probability of at least one cut by June. Lower rates are rocket fuel for precious metals. They reduce the opportunity cost of holding non-yielding assets. They weaken the dollar, they increase inflation expectations, and they drive capital into hard assets. Silver benefits more than gold. Why? Because silver is a hybrid. It's a monetary metal like gold, but it's also an industrial commodity. When rates fall, both dimensions catch fire simultaneously. Third, geopolitical stress, Venezuela tensions, Iran instability, Middle East conflict risk, safe haven flows accelerated over the weekend. Gold surged past $4,400. Silver, as the leveraged play on precious metal stress, moved even faster. These three forces hit the market simultaneously on Monday morning. The result? Silver gapped from $78 to $83 at the open. No gradual climb, a teleportation. Why? Because there were no sellers. Who wants to short silver when China just locked down supply, the Fed is turning dovish, and geopolitical risk is spiking? Nobody. So the price had to jump to find any liquidity. By mid-morning Monday, silver touched $84. Tuesday, January 12th, this morning it broke $85. A 5-day move of over $6. That's 7.5% in less than a week. For context, silver moved 180% in all of 2025. This 7.5% move happened in 5 days. This is not a steady trend, this is acceleration. Now let me show you what's driving the acceleration, because this isn't just momentum. This is three structural forces that are intensifying. Force one, industrial consumption is inelastic. In 2024, industrial silver demand hit 680 million ounces, the highest level ever recorded. Solar photovoltaics alone consume 230 million ounces. That's 34% of total industrial demand. Electric vehicles consumed another 50 million ounces. Electronics, 5G infrastructure, medical devices, semiconductors. The list is endless. And here's the key. This demand doesn't respond to price. If you're a solar panel manufacturer and silver goes from $30 to $85, you don't stop buying. Why? Because silver represents maybe 5 to 10% of your total panel cost. If you stop buying silver, you can't finish the panel. If you can't finish the panel, you lose 100% of the revenue. So you pay the $85. You pay the $100. You pay whatever the market demands. This is called price inelasticity. And it's the nightmare scenario for any commodity market. Because when demand is inelastic and supply is constrained, price becomes the only equilibrium mechanism. And that mechanism can overshoot violently. The Silver Institute projects that solar demand alone will exceed 300 million ounces annually by 2030. Electric vehicle silver demand is expected to triple by 2030 as EV production scales. Data centers, the physical infrastructure powering AI, are the emerging wildcard. These facilities require massive electrical systems. Silver is used in every high-performance contact, switch, and conductor. As AI scales, so does silver consumption. Add it all together, and industrial demand is on track to exceed 750 million ounces by 2028. That's an increase of 70 million ounces per year. Where does that silver come from? Force 2. Mine supply is stagnant. Global mine production has been essentially flat since 2016, around 800 million ounces per year. Why? Because silver is rarely mined alone. 70% of silver comes as a byproduct of copper, lead, and zinc mining. Miners don't dig for silver, they dig for copper. Silver tags along. This creates a structural problem. Silver supply doesn't respond to silver prices. It responds to copper prices, zinc prices, and lead prices. If copper prices are weak, mines don't expand. Even if silver hits $100 per ounce, if copper's at $3 per pound, the mine doesn't get built. And even when mines do get built, they take years. A decade from exploration to production. Environmental permitting, community approvals, financing, construction. By the time a new silver mine comes online in 2035, the demand that exists today will have consumed years of accumulated inventory. There is no quick supply response. The silver is either in the ground or it isn't. And what's in the ground cannot be extracted fast enough to meet what's being consumed today. Force 3. Above ground inventories are collapsing. This is where the math becomes terrifying. COMEX registered silver, the metal available for delivery against futures contracts, has fallen to 113 million ounces as of January 2026. That sounds like a lot. It's not. At current industrial consumption rates, 113 million ounces represents less than 2 months of global demand. If every industrial user tried to secure 6 months of inventory, a prudent hedge in a tight market, the registered vaults would be empty in weeks. London Metal Exchange inventories are similarly stressed. Silver lease rates, the cost to borrow physical metal, spiked above 30% annualized in late 2025. That's crisis-level tightness. When borrowing costs hit 30%, it means physical holders are refusing to lend. They see the shortage. They're hoarding. Shanghai Gold Exchange inventories hit decade lows in late 2025. China's domestic demand is so intense that even with export restrictions, they're draining their own vaults. Here's the critical insight. In 1980, when the Hunt brothers squeezed the market, there was silver available. The shortage was artificial, created by one family hoarding metal. When regulators forced liquidation, supply flooded back. The market normalized. In 2026, the shortage is real. The silver consumed in solar panels doesn't come back. It's embedded in a product with a 25-year lifespan. The silver in electric vehicle wiring harnesses doesn't come back. It's in a car that will be driven for a decade before scrapping. Even then, silver recycling from electronics and end-of-life products recovers less than 20% of embedded silver. The rest is lost to landfills or uneconomical to recover. This means the 600 million ounce deficit over the last 5 years is gone permanently. It's not coming back into the market. It's not available to stabilize prices. It's been consumed by an industrial system that cannot function without it. So when silver hit $85 this morning, the market wasn't pricing in speculation. It was pricing in scarcity. Real, physical, irreversible scarcity. Now let me show you what happens next, because $85 is not the ceiling. It's the floor of the next phase. The technical picture is clear. Silver broke through $80, a psychological and technical resistance level that held for over a year. When major resistance breaks on volume, it often becomes support. The next technical target is $90, then $100. Between 85 and 100, there is very little historical resistance. Why? Because silver has never traded in this range. There's no chart history, no bag holders waiting to sell at break even, no overhead supply. This is called blue sky territory. And in blue sky, price moves are unpredictable. They can be gentle, or they can be violent. Given the inelastic industrial demand, the supply constraints, and the speculative momentum building, expect violence. The gold to silver ratio is another critical metric, currently around 51-1. Historically, during precious metals bull markets, this ratio compresses. In 2011, it hit 30-1. In 1980, it briefly touched 17-1. If gold holds at $4,400 and the ratio compresses to 40-1, silver reaches $110. If the ratio compresses to 30-1, silver reaches $147. These aren't fantasy numbers. These are historical precedents playing out in real time. But the real driver isn't technical, it's fundamental. And the fundamentals are screaming. China's export restrictions went live January 1st. We're only 12 days in. The full impact hasn't hit yet. But it's coming. Western manufacturers who rely on Chinese refined silver are about to face supply disruptions. Lead times are extending. Premiums are spiking. Panic buying hasn't started yet, but it will. When factories realize they can't secure silver at any price, they'll bid aggressively. That bidding will push prices higher. Higher prices will trigger more panic. More panic will drain remaining inventories faster. This is the doom loop, and we're entering it now. The Federal Reserve's policy shift is another accelerant. If the Fed cuts rates even once in 2026, real yields, nominal interest rates minus inflation, compress further. Real yields are already near zero. One rate cut pushes them negative. Negative real yields are historically the most bullish environment for precious metals. Why? Because holding cash loses value. Holding bonds loses value after adjusting for inflation. Holding silver, a hard asset with intrinsic demand, preserves value. Capital flows follow the path of least destruction. And in a negative real yield environment, that path leads to hard assets. Then there's the psychological element. Silver breaking $85 will make headlines. Mainstream media will cover it. Retail investors who ignored silver for years will suddenly pay attention. The fear of missing out is a powerful force. It drove Bitcoin from 20,000 to 60,000 in 2021. It drove GameStop from 20 to 400 in 2021. And it can drive silver from 85 to 150 if the narrative catches fire. The narrative is simple. Silver is the most undervalued strategic metal on Earth. It's essential to the energy transition. Supply is constrained, demand is exploding, and the price is still a fraction of its inflation-adjusted 1980 peak. Speaking of inflation adjustment, the Hunt Brothers peak of $49 in 1980 equals roughly $195 in 2026 dollars. Silver at 85 is still 56% below the inflation-adjusted record. If silver simply returns to its 1980 purchasing power, it needs to more than double from here. But here's the key difference. In 1980, silver's demand was discretionary. Today, it's non-discretionary. In 1980, governments opposed the price rise. Today, governments are driving it through green energy mandates. In 1980, supply could respond. Today, it cannot. This means the inflation-adjusted 1980 peak isn't the ceiling. It's the midpoint. Now let me address what you're thinking. Is this a bubble? Is this sustainable? Or are we about to see another 1980-style collapse? The answer depends on what you mean by bubble. If you define bubble as price disconnected from fundamentals, then no, this is not a bubble. The fundamentals, industrial demand, supply deficit, inventory depletion, are stronger than they've ever been. If you define bubble as unsustainable price appreciation driven by speculation, then maybe, yes. But that speculation is rational. It's not based on hype, it's based on math. The math says industrial demand will exceed 750 million ounces by 2028. The math says mine supply is capped at 800 million ounces. The math says recycling adds maybe 150 million ounces, most of which is already spoken for. The math says inventories are at multi-decade lows and falling. The math says there is no substitute for silver in its primary applications. When you add up that math, $85 per ounce is not expensive. It's repricing to reality. But could we see volatility? Absolutely. Silver is the most volatile major commodity. It can rise 10% in a day. It can fall 10% the next day. If you cannot handle that volatility, silver is not for you. But if you understand that volatility is the cost of exposure to a structural shortage, then the current price is an entry point, not an exit. Here's what I'm watching. First, COMEX registered inventories. If they fall below 100 million ounces, the market will panic. That's the line where industrial users realize there's not enough metal to cover even 1 month of demand. If that happens, we could see a squeeze that makes the Hunt Brothers look like a practice run. Second, Chinese export data. How much refined silver is actually leaving China? If the answer is zero or close to zero, Western supply chains will break. When supply chains break, prices don't rise linearly, they gap. Third, Federal Reserve language. If Fed officials signal more than 2 rate cuts in 2026, precious metals will surge. If they signal hawkishness, we could see a pullback. But given the December jobs data, dovish signals are more likely. Fourth, solar installation data. If global solar deployments exceed 500 gigawatts in 2026, as some forecasts project, silver consumption will spike again. That's another 30 to 50 million ounces of annual demand. Where does it come from? It comes from higher prices rationing demand. Now let me show you what this means for you. This is not financial advice. I'm not a financial advisor. But I can show you the pattern. And the pattern says we're in the early stages of a repricing event. If you own silver, physical or otherwise, the decision is simple. Do not sell into strength. Selling at 85 because it feels high is the mistake retail investors always make. They sell at the breakout. Then they watch it run to 120 and regret it. The strategy is to hold through volatility. Silver will pull back. It might drop to 78. It might drop to 75. Those are not exits. Those are additions. If you don't own silver, the decision is harder. Chasing a 7% move in 5 days is dangerous. You don't want to buy the top. But you also don't want to wait for a pullback that never comes. The prudent approach is to scale in. Buy a small position now at 85. If it pulls back to 80, add more. If it runs to 95 without pulling back, you have exposure. This is about positioning for a decade-long transition, not about timing a day or a week. The energy transition will take 20 years. Silver's role in that transition is locked in. Solar, EVs, and data centers are not going away. They're accelerating. The repricing of silver to reflect that reality will take time, but it will happen. And when it does, the move from 85 to 150 will seem obvious in hindsight. Right now, it seems impossible. That's the opportunity. Let me close with the Hunt brothers comparison one more time, because it's the narrative everyone will use. And it's wrong. The Hunt brothers tried to corner a market that didn't need to be cornered. In 1980, silver supply was abundant, industrial demand was low, the squeeze was artificial, the collapse was inevitable. In 2026, the squeeze is natural. It's not 3 billionaires. It's 3 billion solar panels. It's 100 million electric vehicles. It's 10,000 data centers. It's the entire global economy electrifying, digitizing, and decarbonizing, all at once. And all of it requires silver. The Hunt brothers manipulated the market. In 2026, the market is being manipulated by reality, the reality of physics. Silver conducts electricity better than any other metal at standard temperature. The reality of scarcity. You cannot print silver, you cannot synthesize it, you can only mine it, and we're not mining enough. The reality of demand. Technologies that define the 21st century, solar, EVs, AI, semiconductors, all require silver. Not want it, require it. When reality manipulates a market, regulators are powerless. They cannot change the laws of physics. They cannot create supply that doesn't exist. They cannot stop industries from consuming materials they need to function. This is why $85 is not the top. This is why the Hunt brothers comparison is irrelevant. This is why the next 12 months will redefine what expensive means for silver. January 12th, 2026. Silver broke through 45 years of resistance. It eclipsed the Hunt brothers' peak. And it did it without manipulation, without leverage, without regulatory intervention. It did it because the world needs silver more than silver needs the world's permission to be valuable. The breakout is confirmed. The shortage is real. The demand is structural. And the repricing has only just begun. If you understand what you're watching, you're witnessing a generational wealth transfer. From those who ignored the fundamentals to those who studied them. From those who sold at the breakout to those who held through the volatility. From those who believed the old narratives to those who recognized the new reality. Silver just smashed $85. Not because of hype, not because of speculation, because 680 million ounces per year cannot be sustained by 800 million ounces of production and collapsing inventories. The math is simple. The outcome is inevitable. The only question is whether you positioned before the market fully understood what you already know. That $85 isn't expensive. It's the beginning.